And for the last few years, it has been very cheap, but too cheap for the industry, and the industry doesn't like that. So they're trying to have it both ways. They're trying to have higher prices while still selling their service to society on the basis of their ability to produce a cheap fuel. Then there's the question in BC of whether are you all going to be able to export LNG cheaper than other exporters around the globe. What will be the longevity of production? You know, again, we've been promised that there's enough of this stuff to last 100 years, but what if this is really a short-term bubble such that shale gas production in North America will turn around even within the next 2, 3, 4 years? By the time we have the infrastructure in place for large-scale LNG exports, we may already be seeing declining shale gas production. Now let's turn back to oil. Again, we see basically the same phenomenon as with shale gas. Very high per well decline rates. In the Bakken formation in North Dakota, individual wells have a decline rate of something like 60 to 70% in the first year. But overall, that decline rate gradually goes horizontal. So in the second year, it's a lower percentage decline. So overall, taking into account newly drilled wells that are declining rapidly and older wells that are declining more slowly, the overall production decline rate in the Bakken is about 40% per year. That means the industry has to produce an extra 40% of oil every year just to stay even. Globally, the annual production decline rate is closer to 6%. So you can see there's a big problem for the producers over the long term. The more wells they drill, the harder it is to maintain production. So we did the numbers in our study on the Bakken and the Eagle Ford, and it looks pretty clear that we will have a peak relatively soon, probably by around 2016 in production from the Bakken and Eagle Ford. The EIA, the Energy Information Administration of the U.S. Department of Energy, generally agrees with us that these plays will peak out fairly soon, but the EIA foresees a much longer tail on tight oil production in the U.S., going out to the 2030s and 2040s. We don't see a basis for that. The EIA also sees a lot of tight oil coming from the Monterey Formation in California. Yes, there's a lot of oil there, but looking at the geology, and we did a pretty extensive report on this, the geology is not anything like that in North Dakota or Texas. It's highly folded and faulted. It's not amenable to horizontal drilling, so they're going to be vertical wells. The wells that already exist in the Monterey, the recent wells that have been, the vertical wells that have been fracked, have not been very productive or profitable. There's no reason to think that the Monterey will be anything like as prolific as the EIA is counting on in its projections. So we are probably looking at a situation where, because of the decline in conventional oil that I was talking about earlier in the presentation, and the peak and decline in the tight oil plays in the U.S. by around 2016, we're probably looking at a pretty substantial drop in world oil production beginning next year or the year after. Now, there's a widespread belief in the energy industry that all of the talk about peak oil a few years ago was just scaremongering. Peak oil is dead. But, you know, go back and look at what has been said by the industry and the agencies like U.S. Department of Energy and International Energy Agency over the past 12 years and compare it with what the best peak oil analysts have been saying, and where does the data line up? I actually went back and looked at my first book on peak oil, a book called The Party's Over, published in 2003. I was working on the basis of the analysis of a couple of petroleum geologists named Colin Campbell and Jean Laherrère, and I endorsed their views in my book, which were that conventional oil production would peak around 2005, but that would drive oil prices up, which would incentivize production of unconventional oils, which would in turn peak around 2015. Okay, so that was published in 2003. How close is that to reality compared to what we were seeing in reports from the EIA or the IEA in the early 2000s, which were calling for $30 or $40 a barrel oil and production increasing at 2 or 3% per year until the mid-2030s. So is peak oil dead? I think not. I wish we had been wrong from an economic standpoint, because this is going to be an enormous problem for society, for our economy, and everything we care about. But unfortunately, it looks like we were dead on right. How about the tar sands? Again, an enormous resource in place, but there are some problems with the tar sands. Obvious environmental problems, but also a kind of hidden economic problem that isn't often discussed, and that is that the energy return on energy invested in producing oil from the tar sands is pretty poor, about 5 to 1. Now, that may sound pretty good. I mean, if that were a financial investment and you could, invest $100 and make $500 back in any, reasonable time, that would be, something to write home about. But in the energy world, it's a bit different. Almost everything we do in society uses energy, whether it's healthcare, education, transportation, agriculture. All of those things use energy but don't really produce much energy. So that the energy that we invest in actually producing energy, whether it's drilling oil wells or building solar panels, that has to be really productive in order to fund all the other things we want to do. Historically, during the industrial period, the early industrial period, we were looking at energy returns on, for example, the oil industry of 100 to 1. The coal industry, 80 to 1 or better. Okay? With tar sands at 5 to 1, well, that's getting pretty darn close to the energy returns that were common in agrarian times before the Industrial Revolution. It may be profitable to the companies, the Suncors and the others that are producing the tar sands. It may be profitable to arbitrage cheap natural gas into more expensive syn crude. It may be profitable, but from an energy perspective, this is like turning gold into lead. The tar sands, like all non-renewable resources, are subject to the resource pyramid. The resource pyramid is just a way of characterizing any non-renewable resource. The bit at the top is the easiest to get, cheapest to get, highest quality, the fewest environmental problems with extracting it. And then as you dig down through the resource pyramid, you get to more and more unconventional resources. Now the thing is, the unconventionals are more abundant than the conventionals. If you can go far enough down into the resource pyramid, there's enormous quantities of oil, coal, natural gas. But beyond a certain point, it actually would cost you more energy to get the stuff out of the ground than the fuel will give you when you burn it. And then most of the resource is below that point on the resource pyramid. So it's true, we'll never run out of oil or gas or coal because we'll stop mining or drilling for it way before we get to that point. We'll stop because it doesn't make energy sense or economic sense to persist. Because Canada is depending so much now on the tar sands, there's a kind of dilemma that has emerged. The country still imports a lot of oil mostly for the eastern half of the country, and then exports tar sands oil, but it's paying the global price for the imported oil, and there's less than a decade worth of reserves of conventional natural gas and oil for the country. So there's really no good energy planning from a long-term perspective that's going on. The words that are usually used with regard to Canada's fossil fuel resources are, how can we develop these resources? But think about it. You know, the word develop sounds so good. You know, it's like you develop your muscles, and at the end of the day, after you've exercised and developed your muscles, they're bigger than they were when you started. But that's not what happens when we develop non-renewable resources like coal, oil, and natural gas. We're not developing anything, we're just extracting them. We're liquidating them. So when in my country we talk about, you know, drill here, drill now, my response is, yeah, let's deplete America first. Sure. Is that good economic policy? Well, I've already mentioned energy return on energy invested, and a little bit more needs to be said about that, because from an overall perspective, as we deplete the cheap conventional fossil fuels at the top of the resource pyramid, what's happening is that the overall energy return on energy invested of society is declining. For the US, it's down to roughly 10 to 1 right now. For the world as a whole, closer to 15 to 1. Now, are these numbers that we should worry about? I think so. Below about 10 to 1, we run into what's called the net energy cliff. Above 10 to 1, you see there's not that much difference in practical terms between an energy profit ratio of 100 to 1 and 20 to 1. Still, in either case, you're investing a relatively trivial proportion of society's resources in producing energy, whether it's 100 to 1 or 20 to 1. But once you get down to less than 10 to 1, there's a big difference between 10 to 1 and 7 to 1 and 5 to 1. Can we even operate an industrial society on less than 10 to 1 energy profit ratio? It's actually doubtful. We begin to see more and more of labor going into the energy sector, more and more investment going into the energy sector, and jobs and investment in all other sectors begin to dry up. That's what we're actually seeing right now. Okay, what can and should we be doing about all of this? All of these are pretty daunting problems, and I bring them up to you not just to be, you know, alarming and discouraging, but it's because it's important for us to know what's actually going on around us. These things are not being discussed, for the most part, in the public arena. Yes, we do hear about climate change, but how much do we hear about declining returns on investment in the energy sector, both financial returns and energy returns? And yet, this pattern of declining returns could be pivotal in the fate of our economy.